Hello everyone and welcome back to the best investing podcast in the world. Today I'm going to be sharing my updated thoughts on Hims and Palantir respective valuations and how I think investors need to reframe the way they think about stocks and valuations as we move into the age of exponentials. As we move into this future, I believe that selling a winner early is going to evolve to be the most costly mistake one could ever possibly make in investing. And Hims and Palantir are excellent examples of this at present. Essentially, as technology takes over and the economy becomes a set of networks, essentially, investors need to be thinking differently about managing winners. Here's how I think about it now. Let's get deep into it. The stock market is a counterintuitive environment in that it repeatedly requires investors to act against their emotions in order to succeed. We all know that we should be buying stocks when no one wants them, but in practice, this is nearly impossible to do for most. It's even harder in turn for investors to hold on to stocks when prices increase quickly, as is the case with Hims and Palantir. The extreme fear experienced at both ends of the spectrum keeps 99% of investors from holding onto stocks for long periods of time, which is actually how you make generational wealth, by doing nothing. The emotional fatigue is amplified by the excruciatingly long time horizons involved in investing in the stock market. Although stocks can move quickly, when they correct, they may not recover for years, and corrections happen often enough for investors to be scared about them the whole time. When stocks rise, they may do so for months and perhaps even years on end with no signs of correcting as well. Indeed, investors do not just experience extreme fear for a brief moment. They do so for brutally long periods of time, with even the most psychologically prepared and hardened throwing in the towel eventually. The pain then tends to be further magnified by the procyclical nature of traditional analysts, which rather predictably urge investors to act on their fear and other primitive emotions by downgrading stocks when the stock market goes down and upgrading them when the stock market is in euphoria mode. The antidote to all of this is understanding that over the long term, stock prices track free cash flow per share. As Jeff Bezos once famously said, investors can't spend percentage margins, but they can spend free cash flow. The value of a share, therefore, is a function of how much cash it produces for its owner. While the stock market is an unpredictable and chaotic system, businesses are not. By becoming an extraordinary business analyst, you can spot companies that are highly likely to exponentiate their free cash flow per share and thus outpace their current valuations over the long term, likely many times over. While such companies are rare, a portfolio of them is as close as an investor can get to certainty in the stock market. As Buffett says, in the short term, the stock market is a voting machine and a weighing machine over the long term. There's no guessing what will happen to the prices of your stocks over the short term, but so long as the underlying companies increase their free cash flow per share, your stocks will just do fine over the long term. Throughout a sufficiently long time horizon, a few of your picks will in turn deliver most of your returns. For instance, Spotify and Palantir have each returned my entire portfolio to date, and this is just the beginning for these two companies per my understanding. Hims trades just over 10 times sales, while Palantir trades incredibly at over 100 times sales. While these are materially different valuation multiples, the underlying concern remains the same. Investors will make money if free cash flow per share grows more than the market is currently discounting. Traditional analysts like to label a high valuation multiple, such as Palantir's, as inherently bad on its own. Yet, it's obvious that the valuation won't be much of a problem for investors if Palantir exponentiates free cash flow per share from the current levels, as I believe it will. On the other hand, Hims stock has some way to go before giving investors such a luxurious headache, but in my view, it's very much on the way. On top of the inherent difficulty of navigating the stock market, what confuses contemporaneous investors most is the increasing prevalence of winner-takes-all scenarios. The economy is evolving into a collection of networks with a select number of companies taking their entire respective markets. In turn, the progression of value creation processes has been distorted. Value can be invisible to the untrained eye for long periods of time, only for it to then show up in the income statement and explode to the upside in a very short period of time. This can quickly expand the valuation multiples of a company, greatly confusing traditional analysts and leaving similarly minded investors highly confounded. Networks have effectively pushed us into the age of exponentials. Just because a stock price discounts exponential growth, as does Palantir's at present, it doesn't mean that exponential growth will happen. However, in a portfolio of companies with potential for such kind of growth, a few of them will likely achieve it. In an increasingly winner-takes-all economy, the rest of your picks will likely tend to go to zero over time, time because they will be outpowered by other companies that do take the entire market. The thing is that at any point in time, you don't know for sure which picks will be on what side of the equation, which is why selling a stock as soon as the market starts to discount exponential growth is a terrible mistake. Selling a winner early is the path to remarkable underperformance as the world continues to move towards a network-defined economy with exponential tendencies. By selling winners, you greatly increase the odds of being left with only mediocre companies in your portfolio. Valuation is naturally a paramount consideration when making an investment. I've made all of my money to date by buying extraordinary companies at depressive prices, which I define on average as an under 4 times price to sales. However, buying a company that's set to miss out on a winner-takes-all scenario at a reasonable price is absolutely useless. In the modern economy, buying the right company is slightly more important than what valuation you buy it at. Indeed, many highly intelligent individuals, including industry experts, thought that Palantir and Spotify were terribly expensive when I bought them at $7 and $97.50 respectively. However, I bought these two stocks because I saw limitless potential for free cash flow per share growth and high odds of success, which is now starting to materialize, as you can see in the graphs on the screen now. The valuation of these two companies are now considerably higher, with my Palantir investment being up 15x and Spotify being up over 6x. Indeed, their ability to rapidly innovate and enhance the earning power has led them to rapidly outpace their valuations from just a few years ago. In turn, I believe that so long as their culture remains world-class, the odds of this happening again over the coming 5 years, and perhaps in an even more spectacular way, are highly meaningful. As you can see below, Hims' free cash flow per share is also increasing exponentially, which is the main driver of its stellar stock price performance. When I bought Hims, I didn't focus on the valuation much, and that's to say not at all, as I focused mostly on its ability to drive free cash flow per share. Valuation is generally a loser's game in that if you have to spend too much time thinking about it, the deal is obviously too thin. This is especially true in tech, where winner-takes-all scenarios are so prevalent, and this applies at all stages of corporate development. For example, I continue to hold Spotify, Palantir, and Hims because I see the path for them to increase their free cash flow per share levels by orders of magnitude over the long term. This is why whether their respective stocks are overvalued by some percentage point or even multiple fold at any given point in time is not actually a concern for me. Indeed, playing that game of precision seems excessively hard and somewhat comical in the face of long-term exponential opportunities, which can actually be captured by doing nothing. Hims is a perfect instance of the mental framework that I teach in my Tech Stock Goldmine course, and my original Hims investment is now up over 4x. Funnily enough, I wouldn't have ever found Hims and the conviction to go all in on it if I hadn't sat down to create my course, which then enabled me to see with great clarity the sort of companies that I wanted to buy. This is the same mental framework behind my 25x plus AMD and Tesla investments and behind my aforementioned 15x plus Palantir and 6x plus Spotify picks. The course has been tried and tested by hundreds of happy students, and you can obtain lifetime access for just $350 in the link that you will find below in the show's footnotes. I also have a 14-day money-back, no questions asked guarantee, so all you have to do if you don't absolutely love the course is send me an email asking for a refund. So just type in refund in the subject line and I'll give you a refund straight away without asking a single question. However, 99% of you will absolutely love the course, and you will find that the mental model that I teach in it is incredibly powerful, not to just understand the winners that I'm currently invested in, but to go and find winners on your own and over the long term slowly make a fortune for yourself as well. So thank you very much for joining me. If you enjoyed this update, as always, can I please ask you to share this with one friend? These deep dives are for free, and so the only way this grows is with your help. Thank you very much, take care, and until next time.